Hello guys, in this video we are going to be discussing amendments applicable for December 2021 CEA Inter, Corporate and other laws. Now the amendments which we are going to be discussing in company law, they are very important and very interesting as well. Other laws we do not have any amendments, but then there are a lot of amendments under Companies Act and we'll be going through them chapter by chapter, one by one we will be learning them in full depth. The file that you see on your screen, do not worry about this. This file will be shared with you all. So do not have the pressure, do not feel the pressure of, taking down too many notes along with this lecture. Instead, I would say focus on, trying to learn along with the lecture. Don't focus on running notes, focus on learning along with this lecture instead. All right. And the page number references that you see in this material are references to my book. So in case you already have the hard copy of my colored book, you can keep that book beside you and make corrections or make notes in that side by side as you listen to this lecture. So let's begin. Let's begin with the very first chapter. Starting with the changes in the different types of companies, we have to learn some new provisions in three types of companies: one-person company, small company, and listed company. Starting with one-person company. See, we all know that in a one-person company, we have only one single member, and this one member itself generally becomes a director of the company also. And this member is supposed to appoint a nominee, a person who's going to take his place upon his death. Now, you're also aware that there are a lot of criteria that who can be a member, who can be a nominee. There are a lot of criteria around it. For example, only a natural person, only an individual like you and I, only we can be appointed as members or nominees of one-person companies. Similarly, only an Indian citizen can be appointed as a member or nominee of one-person company. You know about these provisions. In the same manner, there was an earlier provision that only a resident can be appointed as a member or a nominee. But that has been removed. That provision does not exist anymore. As per the latest provision, it is not necessary that the member or nominee should be a resident. They may be a resident, they may not be a resident, doesn't matter. So as per the latest provision, the member and nominee of one-person company, it is not necessary that they should be a resident. They may be a resident, they may not be a resident, doesn't matter. Both can be appointed as member and nominee. Even a resident can be appointed, even a non-resident can be appointed. Are we clear? And one more point, guys. Earlier, a resident was a person who has lived in India for at least 182 days in the preceding financial year. Even this they have changed. So the definition, the meaning of resident itself, they have changed. Earlier, resident was a person who has lived in India in the preceding financial year for at least 182 days. But as per the latest provision, as per the amended provision, a resident would be a person who has lived in India for at least 120 days. So the criteria that who can be a resident of our country, they have relaxed that from 182 days to 120 days. All right. So two changes here. Change number one, it is not necessary that only a resident should be appointed as a member or nominee. Even a non-resident can be appointed as a member or nominee. And change number two, resident is not a person who has lived in India for at least 182 days. You live in India for at least 120 days in the preceding financial year, you will become a resident. Okay. So this is it about the changes in one-person company. Now coming to the next change, there is one more change in one-person company. Earlier, the provision was that if a one-person company wants, it can convert into public company and private company. But it can convert into public or private company only after the expiry of 2 years. But even before the expiry of 2 years, if it wants to convert, it can only if its paid up share capital is more than 50 lakh or turnover is more than 2 crore. You understand? I'll repeat again. Earlier, the provision was one-person company can be converted into private or public company. But if one-person company has to be converted into public or private company, then it can do this conversion only after 2 years. But no, now itself, even before 2 years, we want to convert. Is there some solution? Yes, there is a solution. Earlier, the solution was even before expiry of 2 years, even before 2 years, if you want to do the conversion, then your paid up share capital should be more than 50 lakh or your turnover should be more than 2 crores. Any one criteria fulfilled, then no need to wait for 2 years. Even before 2 years, you can convert. Okay, even this provision has been changed. This provision has been removed from the act, which means as on date, a one-person company can convert into a public company or a private company at any time. It does not have to wait for 2 years. It does not require so much paid up share capital, so much turnover, not required. So as on date, one-person company can be converted into public or private company at any time, absolutely no problem. Even earlier, one-person company could not be converted into Section 8 company. Even now, one-person company cannot be converted into Section 8 company. No change in that. Section 1% company can never get converted into a Section 8 company. But then where is the change? Earlier, the company was supposed to wait for 2 years and only then get converted into public or private. But now, there is no such criteria. Even before the expiry of 2 years, anytime the company wants, even if it does not have so much capital, so much turnover, anytime it wants, it can convert into public company, private company, allowed. Okay, so this is it about a change in one-person company. Okay, guys, now let me take you to the next amendment. There is another amendment in the definition in the meaning of listed companies. See, earlier when we spoke about listed companies and unlisted companies, we would stop with the discussion that listed company is a company whose securities are listed in a stock exchange and an unlisted company is a company whose securities are not listed in a stock exchange. Earlier, we would stop the discussion here itself. But as per the recent amendments in the meaning of listed companies, there's a lot more that we are supposed to learn. Listen to the points one by one. So as per the amended provisions, listed companies are those whose securities are listed on stock exchange. No change over here. RSE over here refers to recognized stock exchange. So even now, listed companies are those companies whose shares are listed on a recognized stock exchange. That point is anyways there. In addition to that, there is one more provision that is newly inserted. And what is that? We have a list of 4 companies over here. These 4 companies were earlier considered as listed companies, but now, henceforth, these 4 companies will not be considered as listed companies. Okay, so listed companies, even earlier the provision was that listed companies are those companies whose securities are listed on a stock exchange. Even now that concept is still existing, no change in that. But there are 4 companies which were earlier considered as listed companies, but they will now not be considered as listed companies anymore. What are those 4 companies? Number 1, those public companies who have not listed equity shares on a stock exchange, but instead they have listed non-convertible debt securities. A public company which has not listed equity shares, but it has listed non-convertible debt securities, non-convertible debentures, non-convertible bonds. So some security is listed in the stock exchange. Because some security is listed in the stock exchange, earlier this company was considered as a listed company. But now what are they saying? Are equity shares listed? No. Then what is listed? Non-convertible debt securities are listed, or non-convertible redeemable preference shares are listed, or both non-convertible debentures and non-convertible redeemable preference shares both are listed. If so, public company, if your equity shares are not listed, but your non-convertible debentures alone are listed, or your non-convertible redeemable preference shares alone are listed, or both debentures and preference shares both are listed, that's all. Equity shares are not listed, no problem. We will not consider you as listed company anymore. This is a big relief, because see, as soon as a company becomes a listed company, a lot of complications start arising. For listed companies, a whole lot of complicated rules, regulations, procedures are applicable. So we are making it a little simpler now. those public companies whose equity shares are not listed, just their non-convertible debt securities, just their non-convertible redeemable preference shares are listed, no problem, we will not consider you as listed companies anymore. These debt securities, these preference shares should be non-convertible and they should have been issued on private placement basis. Okay guys, are we clear? Are you following? So now, as on date, if we see what are listed companies are those companies whose securities are listed on a stock exchange. But for companies, even though their securities are listed on a stock exchange, still they will not be considered as listed companies. What are these 4 companies? Number 1, public companies whose equity shares are not listed, just their non-convertible debentures are listed. Number 2, public companies whose equity shares are not listed, just their non-convertible redeemable preference shares are listed. Number 3, public companies whose equity shares are not listed, just their non-convertible debentures or their non-convertible redeemable preference shares are listed. And what is the 4th company? 4th company, I'm talking about those private companies which have listed non-convertible debentures issued on a private placement basis on a recognized stock exchange. 4th point may be a little hard for you to digest. See, listen, all along we are used to learning that public company may be listed, may be unlisted, but private company means unlisted. Right? This is something which is registered in your mind, that private company securities cannot be listed. But actually, there are some exceptions. Even private companies are allowed to list in some extreme situations, in some exceptional situations allowed by SEBI regulations. So, general rule, private companies, they are not allowed to list the securities. That provision was there even earlier, provision is even now, no change in that. Private company securities cannot be listed. But earlier and even now, there are some exceptional cases allowed by SEBI where even a private company is allowed to list. Okay, so that private company whose equity shares are not listed, but whose non-convertible debentures are listed, then that private company, even though some security is listed, it will not be considered as a listed company. So we said listed companies are companies whose securities are listed in a stock exchange. But we said 4 companies, even though securities are listed in a stock exchange, will not be considered as listed companies, right? And what is the 4th one that we are learning now? Those private companies whose debentures, whose non-convertible debentures issued on private placement basis are listed on a stock exchange. These companies, even though some securities listed on a stock exchange, will not be considered as listed companies. Okay, are you clear with this? So listed company does not include these 4 companies. Each of these 4 companies have listed something or the other. In category 1, public company has listed non-convertible debentures. Second category, public company has listed non-convertible redeemable preference shares. Third category, public company has listed both non-convertible debentures and non-convertible preference shares. 4th category, private company has listed non-convertible debentures. Yes, there is some security or the other which is listed. But then these 4 companies will not be considered as listed companies anymore. Are you clear? Yes. So look at the summary now. Look at the summary. Following companies shall not be considered as listed companies. Number 1, those public companies whose equity shares are not listed, just their non-convertible debt securities are listed. Number 2, public companies whose equity shares are not listed, just their non-convertible redeemable preference shares are listed. Number 3, public companies whose equity shares are not listed, but both of these debentures and preference shares both are listed. And number 4, those private companies whose non-convertible debentures are listed. These securities which are listed should have been issued on private placement basis. Okay, what is private placement? Prospectus chapter, it will be covered. All right, so these are the exclusions. These 4 companies will not be considered as listed companies. I hope you are clear. Now coming to the third concept. Now we're going to be learning about small company. This is very, very important from the examination perspective. In the meaning of small company, the limits have changed. Let us see the amended provision. Let us see the latest provision. What do you mean by a small company? Small company is a company whose paid up share capital is not more than 2 crores. It is up to 2 crores and its turnover is not more than 20 crores. So two criteria: paid up share capital not more than 2 crores, and second, turnover not more than 20 crores. Please repeat along with me again. What are small companies? Those companies whose paid up share capital does not exceed 2 crores and turnover does not exceed 20 crores. This 2 crores number can be increased by the government up to 10 crores, and this 20 crores number can be increased by the government up to 100 crores. These numbers are amended numbers. Earlier, we had different limits. Earlier, we had 50 lakh limit here and 2 crores limit here. But as per the amended provision, as per the latest provision, a small company would be a company whose paid up share capital is within 2 crores and turnover is within 20 crores. But we have 4 companies which will never be considered as small companies. Number 1, public companies. Number 2, holding companies and subsidiary companies. Number 3, Section 8 companies. And number 4, statutory corporations. What are statutory corporations? Statutory corporations are nothing but those companies which have been set up, which have been incorporated under a special statute of the government. Special statute as in under a law of the government. For example, you have NHAI Limited. NHAI Limited it is a statutory company because it is set up under the NHAI Act. All right. So statutory companies are those entities which are set up under a statute, which are incorporated under a law of the government. So small companies are those companies whose paid up share capital is up to 2 crores and turnover is up to 20 crores, and we do not include 4 companies. These 4 companies, even if their paid up share capital does not exceed 2 crores, even if their turnover does not exceed 20 crores, still these 4 companies will never be considered as small companies. Which 4 companies, guys? Public companies, holding company, subsidiary company, Section 8 company, and statutory companies. Repeat again, which 4 companies will never be considered as small companies? Public companies, holding company and subsidiary company, Section 8 company, and statutory companies. One last time, what are the exclusions? Public company, holding and subsidiary company, Section 8 company, and statutory companies. And what are the limits? Turnover, the limit is 20 crores, and capital, the limit is 2 crores. Clear, right? So with this, we are done learning all the amendments, all the changes in the different kinds of companies. Now going ahead to the amendments in the share capital chapter, there is only one tiny amendment here, nothing significant. Let me tell you what it is about. The amendment is relating to rights issue. Now, under rights issue, we know, right, that the company gives the letter of offer to the existing shareholders. Through this letter of offer, the company offers the existing shareholders a certain number of shares which they can buy from the company, which they can subscribe. Right, through the letter of offer, company gives them an option that if the existing shareholders want, they can buy more shares in the company proportionate to the number of shares which they already hold in the company. You're aware of it. Now, this letter of offer will generally give the existing shareholders a certain time limit that within so much time you're supposed to decide whether you want to subscribe or whether you don't want to subscribe. That time limit is minimum 15 days and maximum 30 days. Okay, basically, if the shareholders want to accept the offer, if they want to subscribe to the rights shares, they have to exercise their right. So we will give them a time limit within which they'll have to decide that they want to exercise the right. That time limit, the company will inform the shareholders in the letter of offer. Okay, that time limit will be minimum 15 days, maximum 30 days. You're aware of this? This minimum limit of 15 days, the amendment is that this minimum limit of 15 days can be reduced to any lesser number also by the government. That's all. Okay, so if the company wants, if the company may offer rights shares to existing shareholders. When the company offers rights shares to existing shareholders, shareholders get an option. If they want, they can buy some more shares in the company proportionate to the number of shares that they already hold in the company. The shareholders generally get a time limit within which they'll have to decide whether they want to exercise this right or whether they don't want to exercise this right. This time limit will be given in the letter of offer. This time limit will be minimum 15 days and maximum 30 days. It will be written in the letter of offer, and that time limit should be minimum 15, maximum 30. But now we are giving an option to the government that if the government wants, it can prescribe a number even lesser than 15 days. That's all. This is the only amendment in relation to the share capital chapter. Going ahead with our discussion, now let us see the amendments in the meetings chapter. Even here, we do not have significant amendments. We just have two small changes to study about. Okay, listen to the first amendment. See, we know about section 89, we know about beneficial interest. You must have learned that in case a person is a registered shareholder of the company, but somebody else has beneficial interest in the company, then both these persons have to inform the company that, listen, this person is a registered shareholder, but somebody else is having beneficial interest. In simple words, let us say we have two persons, Mr. A and Mr. B, and we have a company. Mr. A is a registered shareholder of the company. That is, if you look at the company's register of members, you will find Mr. A's name. Okay, so even though Mr. A is a shareholder of the company, the person who is actually enjoying the benefits of these shares is Mr. B. So when this happens, we'll call B as the beneficial owner, right? We'll say Mr. B has beneficial interest. You know about this. And you also know that in case a scenario like this exists, then A and B, they both have to inform to the company, listen, even though Mr. A is the shareholder, registered shareholder, it is B who has beneficial interest. Both of them are supposed to inform this to the company. They are supposed to declare their beneficial interest to the company. And this is something that you are aware of. The new provision, the latest amendment in relation to section 89 gives a power to the central government. What power? That central government, if you want, you can exempt some people from following this section 89. The central government can exempt some persons that even though you are beneficial owner, even though you don't have the benefit, even though you don't have actual interest in shares, even though somebody else is beneficial owner, even though your name is not in the register of members, but you have beneficial interest, you need not disclose all this to the company. In the best interest of the public, if the central government thinks it is necessary, central government may exempt any class of persons from complying with section 89. Central government may exempt some people that even though they don't make this disclosure to the company, they will not be punished. These exemptions may be unconditional or subject to conditions. Simple. Now listen to my next amendment. There is one more amendment in the meetings chapter. Now listen. In the meetings chapter, you would have studied that a lot of resolutions have to be filed with the ROC. For example, you must have learned that whenever we pass special resolutions, a copy of special resolution is to be filed with the ROC. Whenever we pass a resolution relating to winding up of the company, has to be filed with the ROC. So like that, you must have seen a lot of scenarios wherein some resolutions, some agreements, copies have to be filed with the ROC. In that list, one of the points you must have learned would be that in case the board passes a resolution under section 179 subsection 3, then a copy of that board resolution has to be filed with the ROC. This section 179.3 is actually a section which you will be learning only in your CA final. This section 179.3 says that these 11 resolutions, the board of directors will pass at the board meeting. In meetings chapter, you would have studied that these board resolutions, Resolutions passed by the board under 179 subsection 3. These resolutions, in case the board passes, then a copy of that resolution has to be filed with the ROC. You wouldn't have studied what are these 179.3 resolutions. The list of these 11 resolutions you wouldn't have studied because it is not a part of your CA in the syllabus. Okay, now but then you would have studied that 179.3 board resolutions have to be filed with the ROC. Now the amendment is that one of these points in this list, one of the points in 179.3 is that in case the company wants to grant loans or give guarantees or provide securities, then board resolution has to be passed. One of the points in 179 subsection 3 is that in case the company wants to give a loan to somebody or give guarantee to somebody or give security to somebody, then for that the company needs a prior board resolution. And this comes under 179.3, which means in case this resolution is passed, a copy of this resolution will be filed with the ROC, isn't it? But the amendment is that in case my company happens to be a banking company, in case my company happens to be an NBFC, a non-banking finance company, or in case my company happens to be a HFC, a housing finance company, then this resolution need not be filed with the ROC. That's all. We are just giving a relaxation to these three companies: banking companies, NBFCs, housing finance companies. Whenever you give loans in the ordinary course of your business, see, it is the business of these three companies to give loans. So each loan that they give, do they need to pass a board resolution? No. Very logical provision, right? So banking companies, NBFCs, housing finance company, it is your ordinary business, it is your day-to-day business to give loans. So as a part of your day-to-day business, if you're giving loans, if you're giving guarantees, for that board resolution and all, you don't have to file with the ROC. Resolutions under clause F need not be filed with the ROC if the resolution was passed in the ordinary course of business by banking company, NBFC, and housing finance company. That is all about our discussion on changes in the meetings chapter. Only two changes: number one, beneficial interest, and number two, resolutions and agreements to be filed with ROC. So generally, section 179.3 agreements, section 179.3 resolutions passed by board has to be filed with the ROC. But then need not file with the ROC if the resolution is relating to giving loans by a housing finance company, NBFC, or a banking company in the ordinary course of business. I'm sure you would have understood this. Now going to the next chapter, accounts of companies. This is where the major amendments have been newly introduced. This is where you will be learning some important amendments, very, very significant from your examinations perspective. All right, let's begin. Let us see them one by one. Sit down straight, 100% focus, no background music in your mind. All right, try to learn along with me with this lecture. I'll try to go slow. Please make sure that your focus is on learning along with me. I'm sure you do not have a lot of time to devote for this at home, right? So please do not think, okay, I'll watch the lecture now and then later I will study. No, your focus should be to finish off learning with me. All right, so listen. Here we have some 5 amendments. Okay, the first amendment is an annual return. The second amendment, okay, not an amendment. The second point is a new insertion. The third point is an amendment in maintaining books in electronic form. The fourth point is a new insertion in relation to board report. And fifth, the most important, the most spoken about amendment, CSR. Okay, so let us begin. Let's begin with annual return. Now, under annual return, do you remember we studied about the contents of annual return? Remember, we even learned the hint. Our hint was shrimp, MRP, CF. students who've learned law with me, you must be remembering. We learned the contents of annual return with the help of this hint, right? And this I was about indebtedness and F was about foreign institutional investors. So we have a change in these 2 points. Indebtedness has been removed. You don't have to write about the indebtedness of the company in the annual return anymore. And the second change is in the last point where you write details about shares held by foreign institutional investors. The last point we learned all their particulars, their names, their address, which country do they belong to, their percentage of shareholding, all that has to be disclosed in the annual return. This was the old provision. So as per the latest provision, we do not have to disclose indebtedness in the annual return. Also about foreign institutional investors, we don't have to disclose a lot of details. We just have to disclose some limited details about FII. We don't have to disclose details relating to their name, address, country, and so on. Okay. The second point about annual return is that the central government has been given a power that the central government may prescribe an abridged form. Abridged form is a summarized form. If it is a one-person company, small company, and other prescribed companies, then for these companies, central government may come up with its own format of annual return, a simpler version, a smaller version. And the third point under annual return, the form of annual return for OPC, for one-person company and small company, it will be form number MGT7A. All other companies, form number MGT7A. Generally, I do not focus on, form numbers. I don't insist that you should be learning form numbers. But because these are recent insertions, it would be nice if you could remember these 2 form numbers. All right. So let me give you a summary. Point number 1, I told you that under accounts of companies, annual return. In fact, I think for some batches, we must have learned about annual return in the meetings chapter. For some batches, we learned annual return under the meetings chapter. For some batches, I taught annual return under the accounts of companies chapter. And in fact, if I remember right, annual return, in case you're looking for it in the book, you will find it in the book only in the meetings chapter. All right, but nevertheless, so under the contents of annual return, indebtedness point has been removed, and details with respect to foreign institutional investor, still it has to be there in the annual return, but this part has been excluded. All right, second point, in case central government thinks it is required, central government may prescribe a different form for the annual return for one-person company, small company, and other prescribed companies. So accordingly, for one-person company and for small companies, you have a different form. You have form MGT7A, and for all other companies, you have form MGT7. Okay, so this was my first amendment under the accounts chapter about annual return. Now coming to a second amendment about periodic financial statements. This is a newly inserted provision. This is a newly inserted concept. Let's read this entire flowchart and then we will try to understand. What does it say? Central government may require such classes of unlisted companies to prepare financial results on a periodical basis in such form as may be prescribed, to obtain approval of board and complete the audit or limited review of such periodic financial results in the prescribed manner, file a copy with the ROC within 30 days of completion of the relevant period with prescribed fees. Let me explain this to you. See, listen, listed companies, SEBI regulations apply, right? SEBI regulations ask listed companies to prepare quarterly financial statements. Every quarter, they have to prepare some financial statements and all. You have some SEBI regulations, how to prepare, what to prepare, all that SEBI takes care. But applicable only for listed companies. This new provision is giving power to central government, that central government, if you think it is required, you can ask unlisted companies also to prepare these periodical financial statements. Generally, what happens? Listed company, because of SEBI regulations, they have to prepare quarterly financials also. They anyways have to prepare annual financials. In addition to that, even quarterly financials they have to prepare. But now we are telling the central government can ask even unlisted companies that even you have to prepare periodical financials, quarterly or half yearly, depends upon the government, depends upon what rule the government makes. But we are giving a power to the government that the government can ask even unlisted companies to prepare financial statements periodically, to get approval of the board, to get them audited and file them with the ROC. Central government can ask even unlisted companies to, number one, prepare periodic financial statements, to get approval of the board in relation to those periodic financial statements, get those periodical financial statements audited, and even file them with the ROC. They should be filed with the ROC within 30 days from the end of the period. End of the period as in if it is quarterly financials, then from the end of the quarter within 30 days. If they are half yearly financials, end of the 6 months within 30 days. Okay, so understood both my amendments, guys. The first amendment was about annual return. Annual return, we learned about 3 points. Indebtedness, you don't have to write. Foreign institutional investors, limited points only to be written. Then central government may prescribe an abridged version, a summarized version, a simpler version for 1% company, small company. Accordingly, for 1% small company, you have form MGT 7A, and other companies, you have form MGT 7. And then we learned a new provision that central government may ask some unlisted companies that if to prepare periodic financial statements, get board approval, and also get them audited, and also file them with the ROC within 30 days. All right, all clear? Fine. Now listen to my third amendment. You all know that companies are allowed to maintain books of accounts, maintain books and papers in electronic form also, in paper form also, both are allowed. And we have also learned that in case company wants to maintain books of accounts in electronic form, it has to follow a huge list of provisions. For example, it is supposed to keep them accessible in India. The details about the server have to be informed to the ROC. They should be legible. Then they should be retained in the same format in which they were generated. So a lot of rules and regulations you would have learned in relation to accounts and books of accounts and books and papers kept in electronic form, right? Now, in addition to all those points which you have already learned, there is one more point which has been newly inserted, but it is applicable only from the 1st of April 2022. This new point is applicable to those companies who are using a special accounting software. For example, if I'm going to use Tally, or if I'm going to use SAP, if I'm going to use some specific accounting software for the purpose of maintaining my books of accounts electronically, then this new provision says that the accounting software should have a feature of recording audit trail, of creating an edit log of each change made along with the date on which the change was made. And it should also ensure that the audit trail cannot be disabled. Audit trail is something that you would have learned even in your auditing, or you will be learning in your auditing syllabus also. Basically, here what we are saying is that, company, listen, we are allowing you to maintain your books, maintain your records now in electronic form, no problem. But then see, in case you maintain them in a paper form, in case you maintain them in a physical register, if you wrote a number here and if you want to change it later on, you will have to strike it off and then you will have to write the new number. So when you do this, people will know that there has been some change. The change will be evident. So later, anybody who sees this, they will know, okay, something was written earlier and then it was changed. But then, if you're going to maintain an electronic form and if you're going to make a change, will it be evident, guys? No, it will not be evident. You agree with me? For example, let us say in electronic form, I am writing something here. I have written this. Now later, if I want to change it, what will I do? Later, if I want to change it, I will just edit it. Now, after editing it, will you even know that something else was written here earlier? No. So we are allowing you to maintain books of accounts in electronic form, right? But this problem also will arise. This risk is also there that if you edit, we may not know that you have edited. That is why we want your software to be such a software that has a feature of maintaining an audit trail. It should have a feature of creating edit logs, and that feature should not be disabled. That feature should be such that it cannot be disabled. Basically, through this feature, in case any change is made in the books of accounts, any number is changed, then what was the change, on which date the change was made, all these, a log should be maintained by that software. The software should be such that in case any change happens, it should be able to maintain a log of those changes. Okay, guys, you understood? So this is my third point. Not a very, very significant point, but just be aware of it. May be tested as a part of your MCQ questions, possible. Applicable only from 1st April 2022 onwards. In case you're using an accounting software, the accounting software should be such that it has the feature of recording audit trail. Recording audit trail. What is audit trail? Audit trail is a record of what happened when. On this date, a journal entry was passed. Then on this date, this journal entry changed. The numbers were changed. On this date, the narration was inserted. On this date, the debit account was changed. On this date, again, the amount was changed. So basically, creating a history of that entire transaction. Later, if I want to see that what were the changes, what this for one particular transaction, what were the changes in the books of accounts for this one particular transaction, I should be able to recall and see. That is audit trail. So the software should be such that it should be able to maintain an audit trail. It should be able to maintain an edit log, that what are all the edits. Edits are nothing but changes. So what are all the changes that were made in the books of accounts, and when were these changes made? And this feature should be such that it cannot be disabled. Okay, so that was my third point under the accounts chapter. Now coming to the fourth point under the accounts chapter. In the board report, we are going to write a lot of points. Remember, you have studied under the accounts of companies chapter, contents of board report. And those contents of board report we have learned in two parts. Part one is a part which is given under the Companies Act, and second part, another additional list of points given in the rules, right? For the points given in the Companies Act, do you remember the hint which I taught you? The hint was card, cam, film, DQ, right? So students who've learned law with me, do you remember we have learned this hint? On the basis of this hint, we learned the contents of board report as per the Companies Act. Similarly, we also learned some more contents of the board report as per the rules. Now, in the rules, 2 more points have been inserted. So what are the contents of the board report as per rules? 2 more points have been inserted. Number 1, in case any proceedings are pending, or in case any application has been made under the Insolvency and Bankruptcy Code 2016, details about that, and even status of the application, status of the proceeding has to be disclosed in the board report. So under the Insolvency and Bankruptcy Code, if any application has been filed or any proceeding is pending, details about that has to be disclosed in the board report. Then number 2, details of difference between amount of valuation done at the time of one-time settlement and valuation done while taking loan from the banks or financial institutions, along with reasons thereof. Basically, any differences in valuations done with banks when you took a loan, details about these two have to be included in the board report. So these two are extra points to be written in the board report as per the rules. These 4 points, fine. Out of these 4 points, I would say the most important points are the first 2. Okay, so we learned about annual return. Then we learned about a special new provision that central government can ask some unlisted companies also to prepare periodical financial results, periodical financial statements, and not just prepare, even get board approval, even get them audited, and even file them with the ROC. And then we learned that in case you're going to maintain books of accounts and papers in electronic form, then your accounting software should have the feature of maintaining edit logs. And then we learned some extra content under the board report. Now let us begin learning the most important amendment, CSR, Corporate Social Responsibility. This discussion on CSR, I'm going to be discussing this with you in full depth. I will assume that you know nothing about CSR. From scratch, I'm going to be discussing with you. In this video, I'm not going to be discussing with you just the amendments or just the changes in CSR. Instead, the entire concept of CSR afresh, I am discussing with you. Okay, so please listen. Let us go point by point. Corporate social responsibility, very, very important. First of all, what exactly do you mean by corporate social responsibility? What is the logic behind this concept? Company is existing. It is an artificial person. We are allowing the company to exist. We are allowing it to do business. We are allowing it to make money. So it has a responsibility to give back to the society. That is corporate social responsibility. We are putting a responsibility on the company that company, you should give back something to the society. You should do something for the welfare of the society. For example, planting trees or setting up schools or making some affordable houses. So like this, you should be doing something for the benefit of the society. Any charitable activity you do, we cannot call it corporate social responsibility. We have a schedule given in the Companies Act. Schedule 7 of the Companies Act gives us a detailed list of activities. Only those activities you can do under CSR. Alright guys, so CSR is nothing but company's obligation to do something for the welfare of the society, to do something for the benefit of the society. A basic idea about it you've learned. Now let us go ahead and let us see what does the law say about CSR. What is CSR? CSR means activities undertaken by a company in pursuance of its statutory obligation laid down in section 135. First of all, remember, CSR, the section is section 135. You cannot afford to forget this. So section 135 gives us all the provisions relating to CSR. Section 135 is putting a responsibility, putting an obligation on the company. That company, you are supposed to, spend money towards CSR. You are supposed to spend money towards certain activities. So these activities which the company is going to undertake because of this statutory obligation. Statutory obligation means what? An obligation, a responsibility which is put on you by a statute. An obligation, a responsibility which is put on you by a special law. Here that special law, that special statute is section 135 Companies Act only. So section 135 Companies Act is putting an obligation on you that you are supposed to undertake some activities. So these activities which you are undertaking because of this section 135 obligation, those activities are called CSR activities. Understood? These CSR activities should not be any of these 7. So we have 7 points over here. These 7 points are excluded from, 6 points. These 6 points are excluded from the meaning of CSR. What is CSR? Nothing but activities which the company is doing because of an obligation put on the company by section 135. But we have 6 points here. These 6 points will not be considered as CSR. What are these 6 points? Number 1, if a company does something in the ordinary course of its business, that is not CSR. CSR means company is supposed to go out of its way. If it's doing something in the normal, ordinary day-to-day business, that is not CSR. But we have an exception. COVID times, we want to motivate companies to spend their time, energy, and resource in doing research in relation to COVID. So look at the exception. General rule, company does something in the ordinary course of business, not CSR. But we have exception. The exception is in case my company's normal course of business is R&D, research and development. Okay. And as a part of its normal, usual day-to-day business, if it is doing some R&D relating to vaccines, drugs, or medical devices in relation to COVID-19, then in these 3 financial years, whatever the company spends on R&D in relation to vaccines, drugs, and medical devices in relation to COVID-19, even though it is a part of its usual day-to-day business, it will be considered as if it is a CSR activity. Are you clear with this? Did you understand? I'll begin again. Let us say there is a company. Let's say we have a pharmaceutical company. That pharmaceutical company manufactures medicines, sells medicines, and it also, does a lot of research and development work to bring up new medicines, to bring up new vaccines, new compositions and all. So for this pharmaceutical company, doing research on COVID vaccines is usual course of business, part of usual business. Generally, companies does anything as a usual course of business, not considered as CSR. But pharmaceutical company, we will give you an exception. It is your ordinary course of business to do R&D relating to vaccines and medicines and all. But in case, even though it is your ordinary course of business to do this research, in spite of that, whatever research and development activity you do in relation to CSR vaccine, in relation to COVID vaccines, COVID medicines and all, even though it is a part of your day-to-day usual business, no problem, we will still consider as if it is CSR. We will call it as if it is CSR activity, even though it is something that you're doing in the normal course of business. Is this clear? Yes, so companies whose normal course of business is R&D activity of new vaccines, drugs, and medical devices, they may undertake R&D activity of new vaccine, drugs, and medical devices relating to COVID-19. This will be considered as CSR, but only in 2021, 21-22, and 22-23, only for these 3 years. Second exception. If I'm going to make any donation or if I'm going to contribute any money to political party, it will not be considered as CSR. Number 3, if I'm going to do an activity which is going to benefit just my employees, that activity will not be considered as CSR. Number 4, if I'm going to undertake any activity outside India, it will not be considered as CSR. But here also we have an exception. I am doing an activity outside India. What activity? I am training Indian sports personnel. I am training Indian sportsmen, Indian sportswomen outside India. I am giving them training facilities outside India. These sports person are either national level or international level sports person. They are either representing a state in the national level competitions, or they are representing India in the international level tournaments. So even though I am providing training for them outside India, even though it is an activity done outside India, it will be considered as CSR activity. For example, let us say the Tata Group. It is providing training facilities to our Indian sportsmen in London. They have set up a training school in London, a sports camp in London, and there they are providing training facilities for Indian sportsmen in London. Even though it is outside India, it will be considered as CSR. Okay, then number 5, if a company does something on sponsorship basis to derive marketing benefit, you're doing something on sponsorship. For example, you're sponsoring a child's education, okay, but you're advertising about it nicely so that you can gain marketing benefits. You are doing some activity on sponsorship. You are sponsoring the Indian cricket teams to let's say you're sponsoring some Indian cricket teams match, or you're sponsoring some training of India's cricket team. But you're doing that sponsoring activity so that you can derive marketing benefit. You are sponsoring their travel or you're sponsoring their training, but in return you are saying on the jerseys of the cricketers, my company's logo should be printed or my company's logo should be put there. You're understanding? So you're sponsoring on one side you're helping them with training and all, but other side you're asking for advertisement benefit. If your company's logo is seen on the cricketers' jerseys, then automatically advertising is happening, isn't it? So if you do an activity under sponsorship basis, but so that you can derive marketing benefit, it will not be considered as CSR activity. And last point, if you do something just because the law is asking you to do, not Companies Act, just because some other law is asking you to do something. For example, Bonus Act is asking you to pay bonus. Let's say Industrial Disputes Act is asking you to pay some compensation to a deceased employee's family. You're making payments, but because some other law is asking you to make payments, those payments will not be considered as CSR. Okay, so is my first discussion clear? Shall we quickly summarize? Section 135 says that in case a company undertakes any activities because of the obligation put on the company by Section 135, those activities will be called as CSR activities. But we have 6 exclusions. These 6 scenarios will not be considered as CSR activities. Number 1, if you're going to do any activity in the ordinary day-to-day business, it will not be considered as CSR. But if your company is in the business of R&D, research and development relating to medicines and vaccines, and in 3 specified financial years, if it is doing R&D activity relating to COVID vaccines, COVID medicines, COVID drugs, then even though it is a part of normal day-to-day business, it will be considered as CSR. Number 2, contributions to political party, not considered as CSR. Number 3, activities which benefit just the employees of the company, not considered as CSR. Number 4, activities which are undertaken outside India, not considered as CSR. But an activity to train Indian sportsmen outside India, representing states in the national level or representing our country in the international level, even though the training is outside India, it will be considered as CSR activity. Number 5, any activity done on sponsorship basis so that you can get marketing benefits, so that you can get advertising benefits, not considered as CSR. And lastly, anything you do because some law is asking you to do it, anything you do because of a statutory obligation will not be considered as CSR. Okay, first point I'm sure you would have understood. Now listen to my next point. So first we learned what is CSR, then we learned what CSR does not include. Now we are going to see some 2 special points which will be considered as CSR. In case to do CSR activities, you are hiring some volunteers and you're giving them some remuneration. So whatever salary you pay to your CSR staff or to your CSR volunteers will be considered as CSR expenditure. So whatever salary, remuneration, whatever you pay to employees who are helping you with the CSR or to volunteers who are helping you with CSR, that salary will be considered as CSR expenditure. Then number 2, a little later, I will be discussing with you that the company can do CSR activity either by itself or it can do CSR activity through a trust, through a society or through a Section 8 company. In case the company decides to do the CSR activity through another trust, society or Section 8 company, then the company is supposed to inform them that for which activity the money is to be used, for which project the money is to be used, company is supposed to inform them. Company cannot simply give them money and tell them, use this money for CSR. No, company is supposed to tell them for which activity this money is supposed to be used. But in case my company is doing the CSR through trust, society or Section 8 company, and if it does not want to prescribe like this, that for which project how much money is to be used, if it doesn't want to prescribe like this, it can simply contribute to the corpus of the trust, society or Section 8 company. Corpus is like the main fund, it's like the core fund of the trust, society or Section 8 company. In case the trust, society or Section 8 company is created just for the purpose of doing CSR activities, it is incorporated exclusively to do CSR activities only, then instead of telling them for what activity how much has to be spent, you can straight away put money into their corpus. It will be considered as if it is CSR expenditure. This point right now, some of you may not have understood 100%. It's okay. Be patient. This point will anyways be seeing a little later when I teach you about trust society and Section 8 company. Some 20 to 25 minutes down the line, we'll see this point over there. Going ahead with our discussion, there is a certain minimum amount that the company is supposed to spend on CSR. At the minimum, the company is supposed to spend at least 2% of the average net profits of the preceding 3 financial years. Basically, last 3 financial years, company is going to see what was its profit, find the average, and 2% of that is a minimum amount that the company is supposed to spend on CSR. In case the company has been in existence for less than 3 years, then for whatever years the company has been in existence, that many years average the company will take. Clear understanding? Before I go to this point, I'm thinking let me give you a revision of this entire CSR discussion that we've had till now. We learned what is CSR. We learned it is an activity. It is activities which you do because of obligation put on you by Section 135. Then we learned 6 things which are not considered as CSR. What you do in the normal course of business, your contributions to political party, then if you do something which is going to benefit just your employees, something which you do outside India, sponsorship activities, and activities which you do because of statutory obligations. These will not be considered as CSR. We studied. Then we learned we have 2 things which will be included in CSR. If you're going to pay a salary to your CSR staff or to your volunteers who are helping you with CSR, it will be considered as CSR expenditure. And number 2, we learned contribution to a corpus of a Section 8 company, trust or society. Even that will be considered as CSR expenditure. But this point we said we'll keep it pending. Right now may not be the right time to understand this properly. This point will come to it a little later. Now we started learning the next point. We learned what is the minimum amount that the company is supposed to spend on CSR. We learned that last 3 years, you see what is the profit which the company made. Let us say we are in year 4 right now. So 3 preceding previous years, you see what was the company's profit. Then you find a simple average of this profit. Calculate 2% of that. This 2% is the minimum amount which the company is supposed to spend on CSR. Okay, so in year 4, how much money is the company supposed to spend on CSR? In year 4, at the minimum, the company shall spend, too much disturbance, just a moment. Yeah, so in year 4, the company is supposed to spend at the minimum 2% of the average net profits of the last 3 years. But in case the company has been in existence only for 2 years, let us say it is the 3rd year of the company right now. Company has been in existence only for 2 years before this. No problem. In that case, 2 years profit you find the simple average, calculate 2% of that. Okay, so last 3 years, whatever is the average profit of the company, 2% of that average profit, that is a minimum amount which the company is supposed to spend on CSR. Now look at this question over here. For 17-18, how much is the company supposed to spend on CSR? 17-18 means you will see 3 preceding years, 16-17, 15-16, 14-15. So 30 crores, 70 crores, 50 crores. You will find the average of the profit of the last 3 years. A simple average, which is going to be what? 150 divided by 3, which is going to be 50 crores. Of this 50 crores, you will calculate 2%. 2% of 50 crores will be 1 crore. So in 17-18, we'll have to spend 1 crore rupees on CSR activities. Okay, and remember, CSR activities will not include these 6. Apart from these 6, on other Schedule 7 activities, minimum 1 crore rupees you will have to spend. Simple. So average of the net profit of the last 3 preceding financial years, you're going to calculate, and 2% of that average net profit, that will be the minimum amount which the company will have to spend on CSR. Then, what if the company, over enthusiastic cutlet, spends more than 2%? Then what to do? Earlier we said spent more than 2%. Forget about it. You can do nothing. Thank you. But then as per the latest provision, if you spend more than 2%, then whatever excess you spend, that can be carried forward in the subsequent years. If the company spends more than 2% of the average net profits, then whatever excess the company spends, we will allow the company to set it off against the requirement in the succeeding financial years. Let us say in one particular year, let us say in year 4, the company's minimum requirement, the 2% requirement was 1 crore. But the company went overboard and the company spent 1 crore 20 lakhs. So how much extra the company spent? 20 lakhs extra the company spent. So in year 5, year 6, year 7, these 3 years, this 20 lakhs will be allowed to be carried forward. In these 3 years, if the company is not able to spend the required amount on CSR, it can spend 20 lakhs less, because this 20 lakh will be allowed to be set off, against year 5, year 6, year 7. So year 5, year 6, year 7, even if you spend 20 lakhs less, no problem, because year 4's excess will set off. Let's say year 5's minimum requirement was 1 crore 50 lakhs. Year 6's minimum requirement was 1 crore 80 lakhs, and year 7's minimum requirement was 2 crore, let us say. Okay, but in year 5, we actually spent only 1 crore and let's say 40 lakhs. In year 6, so it's okay. We spent something lesser, it's okay. Why it's okay? Because we have 20 lakh excess of year 4. It will be carried forward for 3 years. So year 5, even though I spent 10 lakh less, no problem. I'll set it off against the excess. So I still have 10 lakh rupees excess carried forward. Year 6, we spent only 1.75 crores. No problem. 5 lakhs less you spent, no problem. It will be set off against this 20 lakh which you have carried forward. You still have 5 lakh extra. Year 7, we spent only 1.98 crore. We spent 2 crores less. No problem. We spent 2 lakhs less. No problem. That deficiency will be set off against your brought forward amount. So 5 lakh is brought forward, 2 lakh I will set off, 3 lakh I still have. But year 8, I will not be able to carry forward this year 8. This to year 8. Okay, it can be carried forward only to 3 years. In these 3 years, if you end up spending a little lesser, no problem. You will be allowed to set it off against the excess which you incurred in year 4. Understood? What about this excess 3 lakh? Nothing. This excess 3 lakh will lapse. You cannot carry this forward. Understood, guys? So at the minimum, you're supposed to spend at least 2% of your average net profit of the last 3 preceding financial years on CSR. But what if I incur something more? Great. If you incur something extra, you are allowed to carry forward the excess for how many years? For the next 3 years. Okay, guys. And then net profit, we are having so much discussion about net profit. How to calculate this net profit for CSR? To calculate net profit, don't consider the profit of overseas branches. If you have a branch outside India, profit of that branch you don't consider. Also, if your profit includes dividend income, basically, see, let me discuss this concept with you here. Let us say we're talking about A Limited. A Limited is also a shareholder, let us say, in B Limited. We're talking about A Limited. A Limited is also a shareholder in B Limited. Now, because it is a shareholder in B Limited is giving dividend to A Limited. So this dividend is nothing but income of A Limited, right? And if B Limited is an entity which is properly following CSR provisions, then this dividend income that A Limited is earning from B Limited, this dividend income will not be included in the profits of A Limited. Are you clear? And repeat again. What are we learning? We are learning how to calculate net profit for the purpose of CSR. So here I said that in case you are having any foreign branches, overseas branches, and from there if you're earning any profit, that will not be considered for the purpose of CSR. Then number 2, we learned that in case you are earning any dividend income from an Indian company which is properly complying with CSR provisions, then that dividend income which you're earning from this Indian company, don't include this in your profit number. So from the net profit of the company, remove the profit of the overseas branches. From this net profit, remove the dividend which you have earned from an Indian company which is properly following CSR. Take only the balance net profit. Take only this number. Now understood, right? So with this, we are done learning about the calculation of the profit. So we've learned minimum 2% has to be spent on CSR, 2% of the average net profit of the last 3 years. If you spend something extra, no problem, you will be allowed to carry forward the excess. Then you calculate the net profit for the purpose of CSR. Don't consider the profit of foreign branches. Also, don't consider the dividend income which you have received from an Indian company which is properly following CSR. Understood? Yes, now listen to my next discussion. What if the company does not spend this money? We're asking the company, you should spend 2% of your average net profits. But what if the company does not spend this 2%? Then what will you do? If the company does not spend this 2% in the year, if it spends something lesser, then number one, the board of directors will have to disclose about this in the board report. In the board report, the board of directors will have to give reasons that why didn't we spend 2%. This is number one. Okay, number two, you will see why didn't the company spend this 2%. Is it because the company has an ongoing project? Ongoing project means a multi-year project, a project which extends to many years, a project which is going to go on for more than 1 year, but within 3 years. Okay, so that project is called an ongoing project. So company spent less than 2%. Why? Because the company is spending the CSR money on a project, on a CSR project, which is going to go on for many years, which is going to go on for more than 1 year. And each stage of that project, how much money has to be spent, it is allocated. So according to that allocation schedule, current year the amount required was less only. Subsequent years we will need more money, let us say. Clear understanding? I'll repeat again. Let us say company is having an ongoing project. Ongoing project means what? Let us say it is having a multi-year project. For example, let us say the company, as a part of its CSR project, it is going to construct a school. It's going to construct a residential school for poor people. To construct this residential school, it needs 2 years' time. It is going to extend for more than 1 year, but it is within 3 years. So this will become what? This CSR project becomes a multi-year project. It becomes an ongoing project. Okay. Now in projects like these, you will have an allocation schedule, right? Like for example, you'll have some plan that for for this part, for this phase, for this construction we will need 10 lakhs. This will happen within 2 months. Then for the construction of the main building we will need 5 lakhs. That will be required only after 4 months. Then by the end of this year, within 1 year, we are also going to construct a swimming pool in the school. To construct that we will need 3 lakhs. So like this, you will have a schedule that when in what stages are you going to finish the construction of the school, and for each stage how much money you need. So according to this schedule, current year we did not need so much money, we need only less money. So in case you spend something lesser because you have an ongoing project, then first of all, that ongoing project should be as per the CSR policy. And whatever is the shortfall, whatever is the unspent money, whatever is the deficiency, you see, why are we discussing all this? We're discussing all this because you spent less than 2%. Okay, let's say 2% was 2 crores, but you spent only 1.5 crores. So 50 lakhs less you spent. Why did you spend 50 lakhs less? We will see. Is it because you have an ongoing project? Because next year you're going to spend more. You have an ongoing project. If that is a reason, then that 50 lakh shortfall has to be transferred to a special bank account, which you are now going to open in a scheduled bank called the unspent CSR account. Company you spent lesser on CSR. Why? Because I have an ongoing project right now. This year I did not need to spend so much money. A lot of money I will be spending only next year. It's a multi-year project. Okay, how much less you spent? I spent 50 lakh rupees less. That less money, that deficiency, that shortfall, you know what you should do? Go to a scheduled bank, open a new bank account, call it your unspent CSR account, and put this 50 lakh into that bank account. Within 30 days from the end of the year, you should do this. And within 3 years, you should use this money. Within 3 years, if you don't use this money, then within 3 years, if you don't use this money, then after the expiry of 3 years, within 30 days, the company will withdraw money from this account and put this money into a special fund which is set up under Schedule 7. Little bit you would have understood, little bit you wouldn't have understood. It is okay. Patience, we will see this, and by the end of it, you will all understand properly, I assure you. What is the problem? See, company spent extra, great. We allowed the company set off in subsequent years, story was over. But now the problem is that the company has spent lesser. It has spent lesser than what it was supposed to spend. In that case, we will see what is a deficiency. How much is a deficiency? First of all, company, you've spent something lesser. Board of directors will have to disclose this in the board report. Simple. Second point, company has spent something lesser. We will see why. Why did the company spend lesser? Is it because there is an ongoing project? Ongoing project means what? Ongoing project means a multi-year project, a project which goes on for more than 1 year. It should be as per the CSR policy. It should fit under Schedule 7. It should be for the benefit of the society. It should extend for more than 1 year up to 3 years. If that is the case, then whatever is the unspent amount, whatever is the shortfall, company, take that money, go to a scheduled bank, open a separate bank account, call it XYZ Limited's unspent CSR account, and put the money in that account. From the end of the financial year, within 30 days, you'll have to do this transfer. This money will be allowed to stay in this account maximum only for 3 years. Within 3 years, use that money. Within 3 years, if we don't use that money, then once the 3 years get over, within the next 30 days, we'll have to take out the money from this account and put this money into a fund which is specified in Schedule 7. We have a Schedule 7 fund. In that fund, we have to put this money when 30 days after the expiry of 3 years. Now got it. Now I think you would have understood this point. But all this was only if the company is having an ongoing project. But what if the company spends lesser than 2%, but no ongoing project? It spent less than 2%, but no multi-year project. Then whatever is the shortfall, within 6 months from the end of the financial year, take that shortfall, put into the fund specified under Schedule 7, story over. Please do not get confused. In case there is a multi-year project, money has to be put into unspent account within 30 days from the end of the year. In case we do not have an ongoing project, end of the financial year, you will get 6 months time. Within 6 months, you'll have to transfer to fund specified in Schedule 7. Okay, so this is my third implication. In case my company does not spend that 2% number on CSR, what to do? Thing number 1, board of directors will have to disclose about this in the board report. Thing number 2, in case it is because of an ongoing project, details about this we have to put into, in case it is because of an ongoing project, then we have to put that money into unspent CSR account in a scheduled bank within 30 days from the end of the year. Use it within 3 years. If not used within 3 years, after expiry of 3 years, within the next 30 days, put it into Schedule 7 fund. In case we spend something lesser, but not because of ongoing project, just like that we spent lesser, then whatever is a shortfall within 6 months from the end of the year, put it into the Schedule 7 fund. Clear, 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 crystal clear. Yes, now listen. If any of these provisions the company does not follow, then there will be a penalty on the company also, on the officer in default also. The company will be punished with a fine which is 2 times of the amount that should have been transferred to Schedule 7 fund, or 2 times of the amount which should have been transferred to unspent CSR account, or 1 crore rupees, whichever is lesser. Officer in default will be punished with a fine which is 1/10 of the amount which should have been transferred to Schedule 7 fund, or which should have been transferred to unspent CSR account, or 2 lakh rupees, whichever is lesser. Basically, what is a default here? See, default is not spending money on CSR. Default is not spending lesser on CSR. What is a default? If you spent lesser on CSR, it's okay. We gave you solutions. Put the shortfall into unspent CSR account. Put the shortfall into Schedule 7 fund. Even that you did not do. Shortfall also, you did not put money into unspent CSR account, Schedule 7 fund also. Only then you will be punished. Just because you spend lesser, you will not be punished. You will be punished only if, in spite of spending lesser, you did not put money into the unspent CSR account into the Schedule 7 fund also. Only then you will be punished. Company also will be punished. Officer in default also will be punished. Company 2 times the amount which you should have transferred into those accounts, but you did not transfer, or 1 crore rupees, whichever is less. Officer in default 1/10 of this money which we should have transferred, but we did not transfer, or 2 lakh rupees, whichever is less. Is this clear? Yes, so under CSR, we first learned what is CSR, we learned what is not included in CSR, then we learned what is included in CSR, then we learned what is the minimum amount which we should spend on CSR, and then we learned what if we spend extra, what if we spend lesser. Till here, I hope you have all understood. Going ahead to the next discussion under CSR, the company is supposed to spend 2% of the net profits, right? Now, that amount the company can also spend on buying a capital asset. It can buy a capital asset and give it to a Section 8 company, or to a trust, or to a society which has charitable objectives and which also has a CSR registration number. Or the asset may be given to the beneficiaries of the CSR project, or it may be given to the public authority. So the company is supposed to spend 2% of average net profits on CSR. Now on CSR, on what activities in CSR is the company going to spend? Company has a lot of options that what are the CSR activities it wants to do. One of the options we are giving the company, you can use this money to buy an asset, to buy a capital asset and give it to a Section 8 company, or give it to a registered trust or to a registered society which was made for charitable objectives and has a CSR registration number also. Or you may give it to somebody who's going to benefit from a CSR project. Beneficiaries of CSR project are those persons who are going to benefit out of your CSR project. Or you may also give this money, give this capital asset to a public authority. This is a new concept that the company can use this money, buy a capital asset and give this capital asset to a Section 8 company, registered trust, registered society, which is having charitable objects and a CSR registration number, or give it to beneficiaries of CSR project, or give it to a public authority. Come on, repeat along with me one last time, get it registered into your memory. The company is allowed to buy the capital asset, and this capital asset will be held by whom? Number one, entities like 3 entities, Section 8 companies, registered trust, registered society having charitable objects and having CSR registration number, or beneficiaries of CSR projects, or public authorities. Okay, now coming to my next point. See, when the company is doing a CSR activity, its objective is not making profit out of it. For example, let us say the company wanted to spread awareness about, crackers causing pollution. So to spread this awareness, let us say it decided to conduct a marathon. Now, if it is conducting a marathon, let us say it decided to, have a small entrance fee to help the company meet all the administrative expenses. But then company did not even expect there will be such a good response. So many people joined the marathon, so much entrance fee company collected that the company made some profit. The company had some surplus. Now that surplus, can we call that surplus as profit of the company? With that surplus, can the company declare dividend? No. Whatever surplus the company earns out of CSR projects, out of CSR activities, will not be a part of the business profit of the company. It will not be set off against the requirement to spend in the succeeding years. If the company makes money, makes any profit out of CSR projects, you cannot set it off against subsequent years. For example, this year, if the company made 5 lakh rupees profit out of CSR activity, it doesn't mean next year you can spend 5 lakh rupees less. No. Whatever surplus, whatever profit you make out of CSR activity, you should use it in that same CSR activity, or you should transfer it to unspent CSR account if you have an ongoing project, or you should transfer it to Schedule 7 fund within 6 months from the end of the financial year. You understood? So first of all, the company won't even make any profits out of CSR activities. But by chance, by mistake, if the company does make some profit out of CSR activities, then that profit will not be treated as a company's profit. It will, you cannot say subsequent years, you will spend lesser amount, you will set off the surplus against subsequent years requirement. No. This year you made 5 lakh surplus, doesn't mean next year you can spend 5 lakhs less. No. Then what to do with the surplus? Either you use that surplus in the same CSR activity itself, or you transfer this surplus to unspent CSR account in case ongoing project, multi-year project and all. Otherwise, you simply put this into the Schedule 7 fund within 6 months from the end of the year. Okay, so till here, whatever we have learned is like one part of the CSR discussion. We learned about what is CSR, then we learned what activities will not be considered as CSR, then we learned what will be included under CSR, then we learned how much minimum is to be spent, what if the company does not spend this minimum, what if the company spends more than this, then we learned about penalties, then we learned company can use this money to buy a capital asset and give it to Section 8 company, registered trust, registered society, having charitable objects and having CSR registration number, or to beneficiaries of the project or to public authority. And now we learned what if the company makes any surplus out of CSR activities. That surplus will not be a part of the profits of the company. That surplus cannot be set off against subsequent years obligation, CSR obligation. That surplus should be used for the same CSR activity or transfer to unspent CSR account in case you have an ongoing project, or transfer to Schedule 7 fund. Okay, now shall I take you forward? Shall I take you ahead to the remaining concepts? Till here you should have understood. Now listen, the company will have a CSR committee. The company which is required to spend money on CSR, they will have a CSR committee. This CSR committee will have 3 duties, 3 roles, 3 responsibilities. Number 1, this CSR committee will make a CSR policy and give it to the board of directors. Through the CSR policy, the CSR committee is going to recommend that how much amount has to be spent on which activity. And then it will also it will also monitor whether the company is spending as per the CSR policy or not. So companies which are required to spend money on CSR, they will have a CSR committee. CSR committee will be nothing but a committee within the board of directors itself. This CSR committee has 3 roles, 3 responsibilities, 3 duties. Number 1, this CSR committee will make a CSR policy. Okay, it will formulate a CSR policy and it will give it to the board of directors. This CSR policy will guide the board of directors that how much has to be spent on what activity it has to be spent. And this CSR committee will also monitor, it will also check whether the company is following the CSR policy or not. In the CSR committee, who are the members? It depends upon whether the company has independent directors or not. If the company has independent directors, then in the CSR committee, there will be minimum 3 directors and one of them will be independent director. If the company does not have independent directors, then it should have 2 directors. Okay, so if the company has independent directors, then the CSR committee should have at least 3 directors, that is 2 other directors and 1 independent director should be there in the CSR committee. This is minimum. Okay, but if the company does not have independent directors, then that company shall have minimum 2 directors in the CSR committee. Okay, so I'll give you a summary of this over here. What is the composition of the CSR committee? What is the role of the CSR committee? The role, we said 3 responsibilities, 3 duties. Number 1, formulate a CSR policy. Through the CSR policy, recommend how much is to be spent on what activity and monitor whether the CSR policy is being complied with. Then we learned about the composition of the CSR committee. The composition of the CSR committee depends upon whether the company has independent directors or whether the company does not have independent directors. If it has independent directors, then minimum 3 directors will be there in the CSR committee, wherein one of them at least shall be independent director. This is minimum, can be more also. In case company does not have independent director, then 2 directors will be there in the CSR committee minimum. Company can have more than this also, minimum 2 directors should be there in the CSR committee. Okay, but then listen, every company does not have to follow CSR provisions. Every company does not require a CSR committee. Only if the company fulfills any one out of these 3 criteria, only then the company needs to follow CSR provisions. Only then the company requires CSR committee. Okay, in the preceding financial year, its net worth should be at least 500 crores, or its turnover should be at least 1000 crores, or its net profit should be at least 5 crores. Out of these 3, any one condition should be fulfilled in the preceding year. Only then the company will have to follow CSR provisions. Only then it will require a CSR committee. Very, very important. This indicates to us that every company does not require CSR provisions. Every company does not require CSR committee. Every company is not obligated to spend money on CSR. Only those companies whose net worth in the preceding financial year was at least 500 crores, or only those companies whose turnover in the preceding financial year was at least 1000 crores, or those companies whose net profit in the preceding financial year was at least 5 crores, only these companies have to follow CSR provisions. Only these companies require a CSR committee. Okay, when I say net profit, we will not consider profit of foreign branches. We will not include dividend received from those Indian companies which are following CSR provisions. When we say net worth, we will take paid up share capital, we'll take free reserves, we'll take securities premium. We'll subtract accumulated losses. Accumulated losses is nothing but P&L account debit balance. We'll subtract deferred expenses which are incurred in 1 year, but benefit of which I'm going to enjoy in many years, and hence it is capitalized in the balance sheet. I will also subtract miscellaneous expenses which are not written off, which are appearing in my balance sheet. So, how to calculate net worth? We'll take the paid up share capital plus free reserves plus securities premium. We'll subtract accumulated losses, P&L debit balance. We'll also subtract deferred expenses and miscellaneous expenses if they are appearing in the balance sheet of the company. Revaluation reserves we will not consider. Understood, guys? Okay, so first we learned CSR committee, the 3 roles. Then we learned 2 directors in CSR committee. In case we have independent directors also, then 3 directors are required in the CSR committee, one of whom will be the independent director. Then we learned every company does not require CSR committee, only those companies which in the preceding financial year had a net worth of at least 500 crores or a turnover of at least 1000 crores or a net profit of at least 5 crores. Only these companies are required to have a CSR committee. Only these companies are required to follow CSR provisions. Net worth at least 500 crores, turnover at least 1000 crores, net profit at least 5 crores. To calculate net worth, consider paid up share capital, include free reserves, include securities premium, but subtract accumulated losses, subtract deferred revenue expenses, and subtract miscellaneous expenses which are not written off. Okay, revaluation reserves, in case the company is having any revaluation reserve, don't consider them in net worth calculation. Subtract deferred expenses, subtract miscellaneous expenses only if they are appearing in the balance sheet. Okay, now listen. See, when is CSR committee required? CSR committee is required only if in the preceding financial year, the company's net worth was at least 500 crores or turnover was at least 1000 crores or net profit was at least 5 crores. Only if any of these 3 conditions are fulfilled, only then we will ask the company to have CSR committee. Condition number 1. Condition number 2, the minimum amount to be spent on CSR. What is its minimum amount? 2% of average net profit of 3 preceding financial years, right? This minimum amount should be at least 50 lakhs. Only if both these conditions are fulfilled, only then CSR committee will be even required. Amount to be spent on CSR, if it does not exceed 50 lakhs, then CSR committee is not required. It's not mandatory. You still want to have CSR committee, go ahead, but it is not mandatory. So in such cases, if you don't have CSR committee, then the roles of the CSR committee will be done by the board of directors itself. Okay, so so can I conclude that just because CSR provisions are applicable, CSR committee will not be required? See, if the first condition is fulfilled, then CSR provisions will start applying on the company. Company will have to start spending money on CSR, it will start applying. But just because first condition is fulfilled, CSR committee is not required. CSR committee will be required if second condition also is fulfilled. That is, minimum amount to be spent on CSR should be at least 50 lakhs. Only then CSR committee will be required. Now you would have understood. So if the amount to be spent on CSR is within 50 lakhs, then CSR committee is not required. In that case, functions of the committee will be done by the board of directors itself. Okay, so this is it about my discussion. Another major part of my discussion on CSR. We do have a lot more to discuss on CSR, but till here, I hope you have understood. We learned about what is CSR, we learned what is not included in CSR, how much minimum to spend, what if I don't spend that, what if I spend more than that, what if I made profit out of CSR activities. Then we learned about CSR committee, and then we learned when is CSR provision applicable, when is CSR committee required. Just because CSR provision is applicable, you don't need CSR committee. You need CSR committee if CSR provision is applicable and amount to be spent on CSR is at least 50 lakhs. Both conditions should be fulfilled. Okay, then in 3 years continuously, if these provisions are not fulfilled, 3 years continuously, if condition 1 is not fulfilled, then thereafter CSR provisions company does not have to follow. Let me explain this to you. Let us say in year 3, CSR provisions were applicable to the company. Why? Because net worth was at least 500 crores, or turnover was at least 1000 crores, or net profit was at least 5 crore in the preceding financial year. That is why in year 3, CSR provisions are applicable. Once CSR provisions are applicable, for the next 3 years, whether those conditions are fulfilled or not, next 3 years they will automatically be applicable. If 3 years continuously none of those provisions are fulfilled, which provisions? Net worth, turnover, net profit number I'm talking about. 3 years continuously, if those provisions are not fulfilled, only then you need not follow CSR provisions. Year 3 CSR provisions are fulfilled. Because CSR provisions are fulfilled, CSR you have to follow. You have to spend that money on CSR. 2% of average net profit of 3 years, you will have to spend. The CSR spending will be mandatory. Once CSR provisions are fulfilled, next 3 years also you will have to follow. Okay, year 4, let's say CSR provisions were fulfilled. Again, CSR provisions are fulfilled. So next 3 years, you don't have a choice. You have to follow the CSR spending conditions, 2% you have to spend on CSR. Let us say year 5, CSR provisions not fulfilled. Net worth also less than 500 crores, turnover also less than 1000 crores, net profit also less than 5 crores. Just because year 5 it is not fulfilled doesn't mean year 5 you don't have to spend. You'll still have to spend. Why? Because of the 3 years condition. Year 5 also not fulfilled, year 6 also not fulfilled, year 7 also not fulfilled, let us say. If 3 years continuously, if the CSR provisions are not fulfilled, then you can stop spending money on CSR. 3 years continuously, if CSR provisions are not applicable, 3 years continuously, if none of these 3 conditions are fulfilled, then you can stop spending money on CSR. Is this clear? Only then you can stop spending this money on CSR. I hope you have understood this. Yes, so once CSR is applicable, you'll have to, once those out of the 3 criteria, any one criteria if fulfilled, you'll have to start applying CSR. Once you start applying CSR, next 3 years you'll have to apply CSR. But 3 years continuously, if none of those 3 conditions are fulfilled, then thereafter you can stop applying CSR. Okay, so this is about our discussion on this point. If company ceases to be a company mentioned above for 3 consecutive years, then CSR committee not required, CSR provisions not required. Okay, now listen to my next discussion, CSR policy. We just learned some time back that the CSR committee will have to formulate a CSR policy. Now, what is the CSR policy? The CSR policy is a statement which contains 3 things. Number 1, it contains approach and direction given by board of directors, taking into account recommendations of CSR committee. Then, guiding principles for selection, implementation, and monitoring of activities. And number 3, formulation of the annual action plan. What will the CSR policy contain? The CSR policy will contain what approach the board of directors are going to follow in relation to CSR. What are the principles they are going to follow, on the basis of which they are going to decide which CSR activity to do and which CSR activity not to do. And number 3, a formal annual action plan. Formal annual action plan will contain what are all the CSR projects and the programs, what are all the activities the company is going to do during that year, how is the company going to do them, what is the manner in which those activities are going to be executed, implementation schedule, which activity will be done when, monitoring and reporting process, and need and impact assessment. This need and impact assessment you will be seeing a little later. So CSR policy is nothing but a statement which will contain, number one, what is the approach that the board of directors are going to follow in in doing the CSR activities. Number two, what are the principles which they are going to follow to select which CSR activities to do. And number three, annual action plan also CSR policy will contain. Annual action plan will tell you what are the activities that the company is going to do, what is the manner in which the company is going to execute those activities, whether it is going to do it by itself or whether it is going to do it through another Section 8 company, through another trust or through another society. Then what are the implementation schedules? When is it going to do which activity? Monitoring and reporting process. And lastly, need and impact assessment. 5 things will be contained in the annual action plan. This is about the meaning of CSR policy. Now going ahead to the remaining discussion under CSR, we are going to be seeing now what are the board of directors duties, what are their duties in relation to CSR. Number one, they should see what are the recommendations of the CSR committee. Then on that basis, they should approve a CSR policy. Then number three, they must put the contents of the CSR policy in the board report. Number four, on the website, it must disclose that who and all are the members of the CSR committee, what is the CSR policy, and what are the projects that the company is going to do. Then number five, it should ensure that whatever activities the company is doing for CSR, it should be as per the CSR policy. Number six, it should ensure that those activities are as per Schedule 7. And number seven, it should ensure that the funds disbursed have been utilized as approved by it. CFO or person responsible for financial management shall certify to the effect. Let's discuss these 7 points. Here we are putting some duties on our directors. Number one, we're telling them, you consider, we have the CSR committee. CSR committee is going to recommend to you what are the CSR activities to do. You are not bound by those recommendations. Directors don't have to follow those recommendations, but at least consider, at least take into account the recommendations. Number two, approve the CSR policy for the company. Number three, disclose what will be the CSR policy of the company in the board report. Number four, disclose about who are the members of the CSR committee, what is the CSR policy, what are the CSR projects we are going to do. Disclose all this in the website. Number five, ensure that whatever CSR activities the company is doing should be as per the CSR policy. Then number six, ensure that these activities are as per Schedule 7 of the Act. And then number seven, ensure that whatever funds are being given by the company for CSR activities, those funds should actually be used for CSR activities. Whatever funds are dispersed, whatever funds are given, whatever funds are released for CSR activities, those funds should actually be used towards CSR activities only. Okay, and the fact that the money which is released for CSR has actually been spent for CSR, has not been misused. A certificate to this effect has to be given either by the CFO or whichever officer is responsible for financial management in the company. The board should ensure that whatever money is released for the purpose of CSR is not misused and is used only for the purpose of CSR. The board of the CFO or any other officer of the company who is responsible for financial management also has to give a certificate to this effect that yes, money has not been misused, money has been used only for the purpose of CSR. These are the 7 duties of our directors. Understood? Okay, now listen. For CSR activities, the company may end up incurring some admin expenses and all. The company may end up incurring some managerial and admin expenses in relation to CSR. So administrative overheads, I'm talking about those expenses which are incurred by the company for management and administration. Expenses incurred for designing, implementation, monitoring, and evaluating the project will not be included. The board should ensure that these admin overheads don't exceed 5% of the total CSR expenditure of the company. I'll give you an example. You remember my example I gave you earlier, that story where the company was going to conduct a marathon to spread awareness that how crackers are causing too much pollution, right? So let us say that to conduct this marathon, it has to do some admin work and all. For example, it will need the approval of the traffic police, then it will have to print some pamphlets, it will have to hire some volunteers, it will have to make a lot of phone calls to a lot of people, inviting them to come for the marathon. It will have to spend some postal expenses and all. So all these expenses which the company is going to incur for administering, for managing this marathon, just for the management alone, whatever expenses the company is incurring, that should not be more than 5%. 5% of the total CSR expenditure. Totally on CSR, how much is the company spending? 5% of that amount, that is a maximum admin overhead that the company can spend. The expenses which the company spends to administer and to manage the CSR project should be within 5% of the CSR spend of the company. What is the CSR spend? CSR spend is nothing but, remember we learned 2% of the average net profit of last 3 years. That is a minimum amount that the company is going to spend, right? So that is a minimum amount. See what is the total amount. What is the total? Company may spend extra also. So see what is the company spending on CSR activity. Of that, calculate 5%. That is a maximum amount which you can incur in relation to overheads. Okay, then the company's board of directors will have to prepare a board report. In the board report, they will also have to put an annual report on CSR containing all details relating to CSR. In case the company is supposed to spend at least 10 crores on CSR in 3 preceding financial years, if the average CSR obligation of last 3 years is at least 10 crores, then the company will also have to do an impact assessment on those projects where the company has spent at least 1 crore and which have been completed in the last 1 year. Basically, you remember even earlier we spoke about need and impact assessment. So when is this impact assessment applicable? This impact assessment will be applicable only if the company's minimum CSR spend is at least 10 crores. If the 2% of average net profit of last 3 years, if that is at least 10 crores in 3 preceding financial years, then the company will have to do an impact assessment. Impact assessment means assess that what has been the impact of the CSR activity. The company is doing a CSR activity so that it can benefit the society. So what was the impact of this CSR activity on the society? That has to be checked. That has to be assessed by independent agency. This assessment has to be done for those CSR projects on which the company has spent at least 1 crore. Then that impact assessment report should be put before the board of directors and it will be attached to the annual report on CSR. Let me explain this concept to you over here. See, listen, what did we discuss? We just learned that we will see the 3 preceding financial years. What is the minimum CSR spend of these 3 preceding financial years? We will find the simple average. If that average is at least 10 crores, okay, then all those CSR projects on which the company is spending at least 1 crore, those CSR projects impact assessment has to be done by an independent agency. That independent agency will also have to give an impact assessment report that what is the impact of this project on the society. This impact assessment report has to be attached to the annual report on CSR. This annual report on CSR will be a part of the board report of the directors. Understood? Or are you getting confused? See, let me give you a revision. Relax. I know there's a lot to study under CSR. You've got to be really patient to understand this entire discussion. You may have to see it in bits and pieces. In one stretch, you may not be able to sit and focus properly. It is okay. Listen, admin overhead, maximum how much company can spend? 5% of the total CSR expense of that year. Then the board of directors will have to prepare an annual report on CSR. That has to be included in the board report. To this annual report, you have to attach an impact assessment report. Not always. Only if 3 preceding financial years average CSR spend was at least 10 crores. Then you'll have to prepare, then you have to get impact assessment report, attach it to the annual report. This impact assessment you have to do only of those projects where you spent at least 1 crore. Now clear? 3 preceding financial years, find the average CSR spend. Is it at least 10 crores? If yes, whatever CSR project you spent at least 1 crore in the last 1 year, if you spent at least 1 crore on a CSR project, then on that CSR project, go to an independent agency and get an impact assessment done. That independent agency will give you impact assessment report. Attach that report to the annual CSR report. Annual CSR report will be a part of your board report. Story over. Clear? Okay, now listen to my next discussion. Under CSR, we began with what is CSR. Then we learned what are the activities which the company is allowed to do. Then we learned 2 things which will be included in CSR. Then we learned how much minimum has to be spent. Then we learned what if the company spends excess. Then we learned what if the company spends lesser. Then we learned about ongoing projects and all. Then we learned company can also use that money and buy a capital asset. Then we learned in case company makes any profit out of CSR, that profit cannot be considered as company's business profit. That profit should either be put into that same CSR project, or it should be transferred to unspent CSR bank account, or it should be transferred to CSR fund, Schedule 7 fund. Then we learned about CSR committee. We learned when are CSR provisions applicable. We learned CSR committee is required only if you're spending at more than 50 lakhs. Then we learned that 3 years continuously, if none of the 3 criteria are applicable, then you don't need to follow CSR provisions. You don't need a CSR committee. Then we learned what is CSR policy. We learned duties of the board of directors. In CSR policy, we also learned a new concept of annual action plan. Then we learned how much maximum you can spend on admin overheads. Then we learned about the annual report on CSR, and we learned about impact assessment report. Till here, I hope you are clear. See, listen, CSR especially, if you look at your study material, okay, the sequence in which they have given concepts in the study material is very, very disorganized. You may not be able to, study properly from there, because they've given one concept here, another connected concept they've given in some other corner. So they've not arranged the concepts properly. In fact, a major part of the CSR syllabus of your study material is nothing but a copy paste of the rules given by MCA. They haven't explained properly in the study material. So please, in case you're finding that difficult, you don't even have to look at the study material for CSR. You can learn entirely from this material which I'm giving you all. I assure you it is way more than enough. And I can also assure you that the time that you will take to learn from here will be half than what you will take to study from the study material. Please do from here. It should be way more than enough. Confidently trust me and do just from here. It will be enough. Okay, guys, now listen to my next discussion. The company can either do CSR activities by itself, or it can do a CSR activity. It can do the CSR activities through a Section 8 company registered trust, registered society established by itself or established by the central government, state government. Or it can do through statutory corporation or through another Section 8 company registered trust, registered society with an established track record of 3 years in undertaking similar projects or programs. Board shall specify the projects or programs to be undertaken, modalities of utilization, monitoring and reporting mechanism. Let me explain this concept to you over here. See, we're learning about undertaking CSR activity. We are going to give the company 4 choices. Company, CSR provisions are applicable to you. You have to spend money on CSR. You have to do CSR activities. Company, you can either do CSR activities on your own. By itself, you can do CSR activities. Or you can do CSR activity through other entities. Through which other entities? You have two choices. Either you can do it through a statutory corporation, or you can do through a Section 8 company, or through a registered trust, or through a registered society. Through which Section 8 company, which registered trust, which registered society? Either those Section 8 companies, those registered trusts, those registered societies which are established by the company itself, or those Section 8 companies, those registered trusts, those registered societies established by the central government or by the state government, or those Section 8 companies, those registered trusts, those registered societies which are not established by the company, not established by the central government, but they have a track record of at least 3 years. At least last 3 years, they have been doing these kind of CSR activities and all. Understood? Either do it on your own, or do it through a statutory corporation, or through a Section 8 company, through a registered trust, through a registered society. Which Section 8 company, which registered trust, which registered society? Either one which is established by the company itself, or one which is established by the government, or one which is having a track record of at least 3 years in doing similar activities. Okay, in case the company is going to give money to them, in case the company is going to do the CSR activities through them, then the board has two options. Okay, either the board can simply put the money into the corpus. Remember, we spoke about this earlier. We had kept this concept pending. So in case this Section 8 company, registered trust, registered society, if it is formed exclusively just for the purpose of doing CSR activity, listen carefully, the company is doing CSR activity through these entities, and these entities are formed just for doing CSR activity, then company can simply give the money to the corpus of these entities. Corpus is like the main fund, the core fund. Or if the company is not giving it into the corpus, then the board will have to specify that for which project or for which activity the money has to be spent, how much funds has to be spent for which activity, and how the company is going to monitor whether this entity is properly spending this money or not. You're understanding? CSR activity, either the company can do on its own, or it can do it through other entities. Other entities, two choices, either through a statutory corporation or through a Section 8 company, registered trust, or a registered society. This Section 8 company, registered trust, registered society may either be established by the company, or may be established by the government, or may be an entity which has a track record of at least 3 years in doing these similar activities. In case the company is giving the money to these 3 entities, then the company has two choices. Either these 3 entities should be, exclusively made just to do CSR activities, then company can simply give the money to their corpus without specifying what to invest, how much to invest, where to invest. Or the company may have to specify for which project, for which fund, how much to invest, when to invest. We're understanding? Either the board will directly give the money to their corpus in case they are made exclusively to do CSR activity, or the board will specify that for what project, how much to be spent. If the board is directly putting the money into the corpus, then board need not specify. Board will just give money like as if it is a donation. The board will leave it on these entities. It is a headache of these entities on what to spend, how much to spend. But if these entities are not made exclusively for CSR activity, or if they don't have corpus, then the board will have to specify properly how much to spend, where to spend, when to spend, and how the board will keep monitoring these activities. Okay, in case the board, then the next point, in case the board of directors is going to undertake CSR activity through these entities, then these entities should have a CSR registration number. To get this CSR registration number, they will have to file form CSR1 has to be filed with the government. This form has to be filed electronically. It has to be verified by a professional. It has to be filed with the ROC, and then a unique CSR registration number will be given. If the company wants to do CSR activity through other entities, it can do only through those entities which have a CSR registration number. How will these entities get a CSR registration number? By filing form CSR1 with the ROC electronically. Okay, so this was another important part of our discussion in relation to CSR. Understood? Now listen to my next discussion. Can Reliance and Infosys together do the same CSR activity? Can they collaborate and do projects together? Yes, that is allowed. But in case you want to do it like this, then each company should be able to report separately how much each company has spent. So yes, you are allowed to collaborate with other companies and together spend money on one single CSR project. You are allowed to do that. But in case you want to do it like that, in case together, if you want to, along with another company, if you want to join and do CSR activities, then in that case, you will have to make sure that each company is able to report separately that how much has each company spent on CSR. Separate reporting should be possible. Now going ahead, we just have a few more points to learn under CSR. We're done with the difficult part. Just a few more small points. Number one, this is not a mandatory point. This is just a suggestion that we're giving to the company. That company, when you're doing CSR activities, give preference to local areas in and around that place where the company is situated. Do activities around those areas. Give preference to local areas. If it has a factory in a particular place, give preference to the surrounding areas. If it has a branch office in a particular place, give preference to the surrounding areas. Then company cannot suddenly do some charitable activity and call it CSR. The company has to do CSR activities only in project or program modes. Just suddenly company is conducting one marathon. It is just randomly going and making a donation to a charitable entity. It is sponsoring some TV program. It will not become CSR activity. It should be planned. It should be as per the CSR policy. It should be in the project mode, in the program mode, which means it should be properly planned as per CSR policy. Suddenly, you cannot go and do an activity and call it CSR activity. Then this point is important. To explain this point to you, I will give you an example here. Let us say we have two companies, ABC Inc., which is a foreign company. It was incorporated in USA. It's an American company. It has a subsidiary XYZ Limited. This is an Indian company. This is incorporated in India. So this ABC Inc. is the holding company and this XYZ Limited is a subsidiary company. Let's see. ABC Inc. is giving money to XYZ Limited, and with that money, XYZ Limited is doing some CSR activity. You understood what is happening here? The foreign holding company is doing CSR activity through Indian subsidiary. Who has actually spent the money? ABC Inc. But this CSR activity will be considered as if it is XYZ Limited's CSR. Let us say XYZ Limited net worth is at least 500 crores or turnover is at least 1000 crores or net profit is at least 5 crores in the preceding financial year, which means for this company, CSR provisions are applicable. Okay, so whatever CSR activities are done by the foreign holding company through the Indian subsidiary, those CSR activities, even though it is a foreign company who's actually spent the money, it will be considered as if it is a CSR activity of this Indian subsidiary. Now understood? See, look, now read the theory along with me. If a foreign holding company has an Indian subsidiary and incurs expenditure for CSR activities in India through the Indian subsidiary, it will be considered as CSR expense of the Indian subsidiary. In reality, it is a foreign company which has actually spent the money, but it is through the Indian subsidiary. We will treat it as if it is CSR expenditure of the Indian subsidiary. Okay, and lastly, to train its employees in relation to CSR, to design CSR policies, to monitor CSR policies if the company thinks it can take help of international organizations. It can take help of foreign organizations to help the company in making CSR policies and all. All right, and after this, we just have two more concepts to learn under CSR, Schedule 7 and then about COVID. Now, Schedule 7, you don't have to learn up or memorize this entire list. Just read this list once and just be aware of the points which are written in this list. There are some important points over here, for example, contribution to Swachh Bharat Kosh, contribution to Clean Ganga Fund, eradicating hunger, poverty, promoting health care, then promoting education, then contribution to Prime Minister National Relief Fund. Then you must have heard about PM Cares Fund, Prime Minister Citizen Assistance and Relief in Emergency Situation Fund. So contribution to all these funds will be considered as CSR. Also, if you're going to make a contribution to an IIT or to the government or to the national laboratory or to Indian Council of Medical Research, Department of Atomic Energy, Council of Scientific and Industrial Research, Department of Science and Technology, if you're going to make contribution to all these entities, even that will be considered as CSR. So Schedule 7 activities, make sure you give it a reading and you're aware of the content of the Schedule 7. Please make sure at least aware of it. You don't have to spend too much energy memorizing, just be aware of it. Okay, and then one last point under CSR. The following are eligible CSR activities. If you are spending money for COVID-19, or if you are spending money to create awareness amongst the public to get vaccinated against COVID, or if you are spending money to set up temporary hospitals and temporary COVID care facilities, then these will be considered as CSR activities. Whatever you spend on these activities will be considered as if you have spent money for CSR. Money spent for COVID-19, money spent to create awareness about vaccination against COVID, money spent to set up temporary hospitals and temporary COVID care facilities will be considered as CSR expense. Understood, guys? With this, we are done learning about CSR. I'll give you one small summary now. First, we learned that CSR is nothing but an obligation on the company to do some activities because of Section 135. Anything you do in the normal course of your business, contributions to political parties, activities which benefit just your employees, activities which you do outside India, sponsorship activities to enjoy marketing benefits, and statutory obligations not considered a CSR activity. Then we learned if you're going to give salary to your CSR staff or to your volunteers, it will be considered a CSR spend. Then we learned if you're going to do CSR activity through a trust society or a Section 8 company, which is created exclusively to do CSR activities, you can simply give the money to the corpus of this entity without specifying how much money to be used where. Minimum, you're supposed to spend 2% of the average net profit of the last 3 years. In case you spend more than 2%, you're allowed to carry forward the excess to the next 3 years. In case you spend something lesser, you're supposed to disclose it in the board report. To compute net profit, don't consider profit of foreign branches. Don't consider dividend income from those Indian companies which are following CSR provisions. In case you spend a little lesser, and that is because you have an ongoing project, then the shortfall, the deficiency, transfer to unspent CSR account within 30 days from the end of the year. Use it within 3 years. Otherwise, after 3 years get over, within the next 30 days, you'll have to transfer into Schedule 7 fund. In case you spend something lesser and it is not relating to an ongoing project, then within 6 months from the end of the year, transfer it to Schedule 7 fund. Then we learned in case you want, you can spend the money to get a capital asset and to give it to a charitable entity, to a Section 8 company, to a registered trust or a registered society, which is formed for charitable objects and has CSR registration number. Then we learned in case you made any profit out of a CSR activity, it will not be considered as your business profit. It also shall not be set off against requirements, CSR requirements of subsequent years. Instead, you're supposed to use it for the same CSR project or transfer it to an unspent CSR account or transfer it to Schedule 7 fund within 6 months from the end of the year. Then we learned CSR committee will formulate a CSR policy, recommend how much to be spent on which activity, and will monitor. CSR committee will have 2 members minimum. In case company has independent director, it will have 3 members minimum, 3 directors minimum, one of whom will be independent director. Then we learned CSR provisions not applicable to every company, applicable only to those companies which have a net worth of at least 500 crores or turnover of at least 1000 crores or a net profit of at least 5 crores in the preceding financial year. To compute net worth, consider paid up share capital, free reserves, securities premium. Subtract accumulated losses, deferred expenses, and miscellaneous expenses not written off. Then we learned just because CSR provisions are applicable, you don't need a CSR committee. You need a CSR committee only if the amount which you're going to spend on CSR is at least 50 lakhs. And then we learned 3 years continuously. If CSR provisions are not applicable, then you need not spend money on CSR anymore. Then we learned what is CSR policy. We learned the 7 duties of our directors. Then we learned admin overheads should not be more than 5% of the total amount which we are spending on CSR. Then we learned 3 preceding financial years. If my average CSR obligation was at least 10 crores, then all those projects on which we spent at least 1 crore in the last 1 year, we have to get impact assessment done by an independent agency. Attach the impact assessment report to the annual CSR report. Annual CSR report has to be put into the board report. Then we learned company may do CSR activities either by itself or through a statutory corporation or through a Section 8 company registered trust registered society set up by itself or by the government or having a track record of at least 3 years. Either specify for which activity how much to be spent or straight away put money into their corpus. They should have CSR registration number by filing CSR1 with the ROC. Then we learned companies can do together also, but they should be able to report separately. Give preference to local areas. Don't do one-off events. Foreign companies spending through Indian subsidiary as if Indian subsidiary is spending. And then we learned what are the Schedule 7 activities. And finally, we learned about the connection between CSR and COVID. With this, I hope all of you are crystal clear with our entire discussion in relation to CSR. Yes, guys, a big sigh of relief. Yes, so this is very, very, very important from the perspective of your upcoming December exam. Very important. All right, so with this, we are done with the amendments in relation to the accounts chapter. We learned totally 5 amendments under the accounts chapter: annual return. Then we learned about the periodical financial statement, unlisted companies, remember. Then we learned about board report. And then we learned about electronic books of accounts, special point, audit trail, edit log. And now we learned about CSR. I hope you are all clear with this. We just have one more amendment to learn. Let's do that. Going ahead now to the last part of the amendments. We just have one amendment in the auditors chapter left. And that is in the audit report, we have learned, right, that there are so many things to be written in the audit report. You remember you would have studied that the auditor is supposed to inquire whether the company has given loans which are prejudicial to company's interests, book entries, then whether personal expenses are debited into the company's P&L account. Then the auditor is supposed to report whether branch audit has been done by some other auditor, whether branch accounts proper returns have been received. So like that, whether accounting standards have been properly complied with or not, whether the books and the financials, whether they match or not. So you have already learned a big, huge list of, contents of the audit report. In addition to all that, there are 5 extra points, which the auditor will have to write in the audit report financial year 22-23 onwards. Okay, we have five additional points to be written by the auditor in the audit report financial year 22-23 onwards. What are those 5 points? We are seeing one by one. Number 1, whether the management has represented to the best of its knowledge and belief that in addition to the loans disclosed in the notes to accounts, no funds have been advanced or loaned or invested by the company to any other entity called the intermediary, with the understanding, whether in writing or not, that the intermediary shall lend or invest in other persons or entities by or on behalf of the company called the ultimate beneficiaries, or provide guarantee or security on behalf of ultimate beneficiary. To explain this first point to you, listen to me. Basically, we have a company, we have another entity, and then there is another entity. This entity will be called the intermediary, and this entity will be called the ultimate beneficiary. The first point over here is about loans, guarantees which the company has given to this entity under an agreement that this entity, this first entity, will pass on the loan to this entity. That is what we're learning. Whether the management has, basically, in case a company has given a loan to another entity under an agreement that this entity shall give a loan to another entity, then this has to be disclosed. So the auditor is going to report in the audit report whether the company, whether the management has given and has given a statement that, according to them, to the best of their knowledge and belief, whether all these loans are properly disclosed in the financials or not. So in case company is giving loan to an intermediary, which is going to forward the loan to another entity, the ultimate beneficiary, this has to be properly disclosed in the financials basically. Similarly, point number 2, whether the management has represented to the best of its knowledge and belief, in addition to the amounts disclosed in the notes to accounts, no funds have been received by the company from any person or entity called the funding parties, with the understanding that company shall lend or invest in other persons or entities on behalf of the funding party or give guarantee. Basically, here I'm talking about a scenario where I have an entity, I have the company, and I have another entity. This entity is giving some loan or some funds to my company under a condition, under an agreement that the company shall forward the loan or will invest that money to this other entity. This first entity will be called the funding entity, and the second entity will be called the ultimate beneficiary. See, all this is not wrong. It is just that if these arrangements are there, they should be disclosed in the accounts. So the management has to give a report, the management has to give a statement, the company has to give a statement that they have properly, disclosed all this in the financials. So in the audit report, auditor will write whether the management has given such a representation. Okay, so number 1, the first representation, whether the company has given loan to an entity under an agreement that this entity will forward the loan to another entity or it will invest in this other entity. Second, whether some other entity has given money to the company under a condition that this company will forward the loan to another entity or will invest in another entity. Then number 3, on the basis of audit procedures considered reasonable and appropriate by the auditor, nothing has come to his notice that caused him to believe that the above representations contain material misstatement. See, the first 2 points we spoke about is whether the management has given the auditor a representation or not. Both the first 2 points are whether the management has given a representation to the auditor. What representation? That, all these agreements are properly disclosed in the financials. I just told you all this is not wrong. It's just that it should be properly disclosed. So the management has to give a representation to the auditor whether it is disclosed or not. In the third point, we are asking the auditor that auditor, you do your audit procedures. You do the usual audit procedures as per standards of auditing. You do your audit procedures. On the basis of audit procedures, what do you think? Has the management given a correct representation, or does the managerial representation contain a misstatement? Misstatement means what? See, basically, we are asking the auditor to check whether this representation is correct or not. We are asking the auditor to check, according to him, whether all these are properly disclosed or not. First 2 points is whether the management has given representation to the auditor. Third point, we're putting responsibility on the auditor. Auditor, you do your audit procedures and you check whether what the management is saying is correct or not. Okay, then 4 and 5 are simple. Number 4, whether if dividend company has paid dividend, and whether the dividend is paid according to Companies Act or not. And number 5, remember we spoke about the audit trail point. Same thing. In case the company is using an accounting software, whether it can record audit trail, edit log, whether it operated through the year, audit trail should not be tampered with, and audit trail should be preserved. That's all. So these are the 5 extra points that we want the company's auditors to make sure that they write in the audit report. Okay, applicable only financial year 22-23 onwards. Okay, so number one and 2, whether the management has given representations or not. Number 3, auditor's own responsibility. Number 4, dividend, and number 5, audit trail. All clear? Yes, so this is it with our amendments in the auditors chapter. I hope till here you are all clear. See, in addition to all these amendments that we have seen across so many chapters, another major bulk of the amendments applicable for your examination is penalties. See, generally I don't stress upon penalties because it's too much effort to learn them up. I mean, if I'm going to be really honest with you, then I don't think even I know all these penalties by heart. Some important penalties like Section 447, resignation of auditor, Section 10A penalty, CSR penalty, all these are important penalties which we should be knowing. But over and above them, other penalties I generally ask you all not to study, not to waste your time. But then for your examination, there are a lot of amendments in penalties, which makes me guess that most probably in your examination, you may get a question on penalties. Now, this is something that you'll actually have to sit and study. At least these penalties where there are amendments, do at least them. At least try doing them how much ever you can. But in case you're finding it very, very difficult, and if you are confident about the rest of the syllabus, then I think you can afford to take a small risk also if you don't want to do the penalties, provided you are thorough with the rest of the syllabus. Okay, so these penalties you'll have to sit and just go through them. At least the ones which are amended, I've put over here. You don't have to learn the earlier provision, just learn the amended provision. Right? So with this, we are done with our discussion on the amendments. I hope these amendment discussions gave you the required clarity. All right. Learn them up with a positive attitude. All right. I know we are close to the examination, but at this point, we cannot afford to be nervous. We don't want shivering hands, cold feet. We don't want all that. Walk into the examination hall with full confidence. All right. So do all these amendments properly. Pay a little extra attention on CSR. In all probability, you will obviously have one question from CSR in your examination. Make sure you crack it. All right. So I'll end the session here. All the very best. In case you ever have a doubt relating to these sessions or anything you want to ask, you can always WhatsApp me. Okay, so we'll close over here. Thank you, guys.